In July of this year, the federal government announced additional rules to the mortgage industry. These rules are aimed at cooling down a hot housing sector and, in addition, ensuring that the average consumer does not take on more debt than they can afford. There are 4 changes that we would like to review with you. 1. Mortgage amortizations have been reduced to 25 years from 30 years. In effect, this increases a mortgage payment by $150 a month based on a 3.29% mortgage interest rate. On a $300,000 mortgage, you must now have qualifying income of $62,000 versus the old rules at $56,000 annually. We feel that this will have the most impact as 40% of all new mortgages last year had amortizations of 30 years. 2. Debt service ratios have been increased upwards. Debt service is the amount of money you're allowed to borrow based on a percentage of your income. Under the old rules, gross debt service, or GDS, was set at 35%, and total debt service, or TDS, was set at 42%. There were exceptions made to go above those amounts on a case-by-case basis if you had a credit score in excess of 680. Under the new rules, GDS is now set at 39% and TDS is set at 44%. However, we have seen that most institutions are still following the old rules at 35 and 42 and only following the new rules based on an exception basis. 3. The mortgage refinance rules have also changed. The loan-to-value is now reduced to 80% from 85%. What this means is that Canadians will now have less access to the equity in their home to make major purchases or to consolidate debt. We feel that this actually is a forced savings plan. 4. Homes with a value of $1 million or more will no longer qualify for mortgage insurance. You must now have 20% down in order to purchase these homes. This should have the least effect on the average Canadian consumer. The main thing to remember is contact a mortgage professional who can clearly outline the new rules and see how these rules may affect you.